Well, not many are expecting the Fed to start to lower rates when the FOMC meeting concludes today. What again will be important will be the messaging by Chair Powell in his press briefing after that meeting concludes. Nina Trentman, senior editor with Bloomberg, joins us with more on that. Nina, great to talk to you again.
Thanks for having me.
Yeah, I guess understanding the thinking of the Fed and how they are believing their path on potentially lowering rates is really the thing to watch out for.
Yeah, I think, as you said, sort of what matters is what Jerome Powell says about the outlook for rate cuts this year and next. Powell has been saying that the central bank wasn't far from the level of confidence it needs to start lowering rates. That view was more encouraging than that of some of his colleagues who have emphasized that they'll be patient with considering any more rate cuts. I think, of course, interesting was the most recent inflation reading that we saw, which came in a little hotter than expected. And then at the same time, we also saw increases in the unemployment rate to 3.9% in February. So those two things that the Fed is watching, which is on the one hand inflation, on the other hand the labor market, those have been sending somewhat different signals recently. And so it will be interesting to see what Jerome Powell makes of that, and also then what he tells us about sort of the Fed expectations for interest rate cuts this year.
Yeah, the other thing would be the dot plot, to kind of get an idea of what all of the central bank leaders feel is going to be the path of interest rates and inflation as we move forward over the next 12 months.
Yeah, the dot plot is the word that has been coming up a lot in conference calls and in meetings in recent weeks. This question as to what's the outlook there. Interesting, of course, is also this that the Fed in December, if we go back to that, had projected up to 75 basis points of cuts this year. Most recently, we had heard traders paring back their bets on interest rate cuts. We're still seeing, if we look at a survey of economists that Bloomberg News did recently, we still see that most economists still expect the Fed to pencil in 3 cuts this year with the first move in June, so later than originally anticipated, which would have been this meeting in March. But there's also more than a third that are expecting 2 cuts or fewer. So that is very much a big question this today and also in the coming weeks and months as to when and how the Fed will move.
And realistically, one of the, I guess, kind of common themes that we're seeing play out is that everything seemingly is taking a lot longer than expected. I mean, you go back to the beginning of the year, you kind of alluded to it, everybody was talking about 6 rate cuts at the beginning of the year. Now it looks like we're going to see 2 or 3. Hitting that 2% target on inflation, there are some people that believe that it may now not occur until 2026. And it had been talked about 2025 for a long time, and even before that, 2024. So the process of dealing with what all happened with the pandemic, the economic shocks in there, have really kind of stretched things out here.
Yeah, I think it's interesting to see sort of this, that the market was pretty optimistic once they saw these comments from the Fed in December, whilst the Fed actually since then has been trying to sort of reduce that enthusiasm and actually get people back to focusing first and foremost on inflation, which would then drive decision-making by the Fed. I think one important thing is to keep in mind that the economy is still pretty strong. Many people were expecting some form of recession for last year, which hasn't happened. And whilst we are seeing some slowing in the labor market, we're still seeing a very, very healthy economy, and therefore there isn't necessarily any pressure on the Fed to start cutting rates. And of course, they don't want to do it too soon. They don't want to see an acceleration or re-acceleration in inflation, whilst at the same time also they don't want to be too late and cause a recession by keeping interest rates as high as they are and moving too late to help soften that blow. So it's a tricky situation that the Fed is in. Of course, there's lots of data points that they have, and we will see this afternoon what their reading is of the latest data points, and also what they think is going to happen going forward. I think one thing is also important, sort of thinking about corporates here. So what I've been hearing from CFOs in recent days is very much this, that they will want to see clues from Powell on the outlook for the economy, given that influences how they think about the year going forward and about their forecasts and plans. High rates haven't really stopped companies from tapping bond markets in recent weeks, given that spreads over treasuries have been very low. So we actually hit another record yesterday with like $501 billion in new investment-grade bonds sold so far this year, which is the fastest pace ever, according to Bloomberg data. So it's interesting also that companies are coming to the market at this pace and with this volume at times when interest rates are at north of 5%.
Is the expectation that when the Fed does begin to cut rates, that it's going to be a point at a time and probably for a while, and it would really have to take something drastic, to the downside where inflation takes a big leap lower to see a 50 basis point cut?
Yeah, I think so. I think that the expectation is very much that sort of the first cut will be pretty nuanced. So a cut in the name, but not necessarily a very significant one. And I would very much expect that the Fed will take its time before it would move to a cut as big as the one that you described, given that also it doesn't want to shock the markets, it doesn't want to surprise consumers, it doesn't want to rock the boat, so to say. And so my expectation, and I think also that of many of my colleagues here at Bloomberg, is that if we start to see cuts, it will be nuanced, given that so far we haven't seen any data points that would indicate like a drastic deterioration in economic sentiment or any sudden changes.
Nina, let me put you in the press briefing later today and give you the opportunity to ask Chair Powell a question in that briefing. What's the one thing that's on your mind that you would want to ask him right now?
I would probably want to ask him how come that markets have been so optimistic about rate cuts and why they aren't in a rush to cut. That is probably the thing that I find the most interesting, sort of the fact that markets have been so buoyant in terms of expecting rate cuts and the Fed being so much more cautious. I think that is an interesting gap that we've seen in recent weeks and months, even though the two have narrowed, have come closer together in recent days and weeks. But there is this question as to how effective is communication by the Fed, right?
Yeah. Nina, great to talk to you. As always, thanks very much. We will catch up with you again down the road.
Thank you very much for having me. Appreciate it.
You got it. Nina Trentman, who is a senior editor with Bloomberg. All right, first hour of the show is complete as we head to the break. Markets now mixed. Dow Industrial Average is up 27 points, 39,137. NASDAQ is still in the red, down by 11. The S&P 500 is up by a fraction of a point. Oil prices still continuing to pull back. In fact, pulling back a little bit more than they had earlier. Down 2.25% right now for West Texas crude on the trading session, $81.66 a barrel. So we'll keep an eye on those as we go into the second hour. As we roll into the second hour of the show, when we come back, you'll hear from Wharton's Barbara Kahn, a conversation with her about the world of marketing and companies like Bubbly, Impossible Foods, Tropicana, Honda, Google, and more. We will talk with her coming up in just a little bit. And then we will talk with Jeff Ostrowski of Bankrate about why it seems like younger generations are buying homes and the down payment for those homes is coming out of their retirement savings. All of that as we roll on with Wharton Business Daily here at Sirius XM 132.